What do you make of this? There was a lot of talk about whether we were worried about a second wave and what it would do to the economy and the markets. I'm not sure we priced in fully that the first wave never quite left us.
No, I think it's a great point, David. We never really got to find out about the second wave. We're still very much in the middle of the first. To be honest, we're not surprised. We believe that the whole recovery is going to be much slower and much more uneven than most people believe, and certainly than's priced into the markets. I think having some of these sharp increases in cases is actually quite natural, and I think we will continue to have them and have hotspots and flare-ups as we go. What we've got to do is to decide that actually individual behavior needs to change. Far too many people think that when a state opens up that we can go back to behaving the way that we used to. And we are unfortunately in for a period where social distancing and masks are going to be the way we need to live for the foreseeable future. And I think that we need to learn to practice those in order to open up safely. So the net of all of that, David, is that we're going to have a very slow recovery. We are going to have, we think the economy will be smaller at the end of 2021 than it finished 2019. And markets are priced for a much sharper V-shaped recovery, which we don't think is likely. And so the risk-off trade that you're seeing today and in much of June is likely, we think, to continue through the summer.
So, David, this is a really important point because there was a time we thought maybe we'd be back to the size we were in 2019 by the first or second quarter of 2021. Then markets seem to be pricing in, as you say, by the end of 2021. You're saying that's overly optimistic as well. Do you have any sense of when we might get back there, recognizing the way is not going to be smooth to get there?
No, it's going to be quite uneven, and obviously it's very uncertain. The progress on the vaccine will have an enormous amount to do with confidence. And this is all going to be about confidence and individuals coming back to consume the way that they did and come together the way that they did. We believe that if we have kind of the normal path of this, that people are not going to be, particularly for many of the services businesses or travel, are going to be going back to the way they were for at least 18 months. And so for us, we're going to have depressed consumption and demand that will last well into 2021.
So, David, the government has already done an awful lot, both on the monetary and the fiscal side. There's a lot of clamor now for it to do more. Does more need to be done? And if more is done, where does it need to be directed at to really make the biggest difference?
No, it's a great point, David. I think you have to give the Fed full marks for both the breadth and the power of what they've done to stabilize markets. And even the early stimulus packages, I think, were largely on target, even if they weren't perfect. But more needs to be done, and it needs to be done in two areas. First is that we need to get more money into the hands of small businesses. The PPP plan that was originally envisioned essentially was a very short-term program which aimed at trying to keep up employment and keep paychecks coming. We now realize that this is going to be a much longer problem, and businesses are going to need to be bridged for a far longer period of time if this is going to work. And so we need a new program that is far more flexible and is more long-term for small business. And then secondly, David, you and I have talked about this before, states, cities, and municipalities are headed for a world of pain. There are going to be very significant drops in the revenues that they have from all kinds of different taxes. And that's going to mean that they often have to cut services unless we have another way out for them. And these services are what we care so much about now. They're EMS, they're healthcare, they're education, they're firefighters. And so you've already started to see this. You saw the mayor of New York come out talking about possible cuts just this week. We need a federal program that actually will stabilize, particularly the cities and municipalities as we go through this. And I realize this is a politically difficult thing to do, but I'm just arguing from a purely economic, pragmatic point of view. We cannot have major unemployment happening in our states, cities, and municipalities.
David, you and I have talked in the past about the savings problem for retirement in this country, frankly, around the world. This is making it far worse. We're looking at zero or close to zero interest rates for a long time to come. Are we borrowing from the future to some extent for the present? We may need to do it in order to get us through this rough patch. But as a practical matter, are we going to have the capital necessary to really increase productivity to get growth going again?
Well, there's a lot in that, David, and I think you're really right to point it out. First, this is all extremely difficult on savers, and the entire lower for longer thesis, which has been true for the last decade, and we believe will be true going forward, means that savers are going to have an extremely rough time of it. That's going to mean that they save more. That's going to mean actually that consumption probably goes down. So it becomes a bit self-reinforcing within the economy and keeps growth low. On the flip side of things, there's very little evidence that the low interest rates and certainly negative interest rates actually stimulates companies to invest. And so we're not really getting the benefit of it on the other side. And you're right to point out we need to do this to get us through this period, but longer term, we're going to need to come back to historic levels of productivity if we're going to have our current economy go back to its old levels of growth.
So finally, David, let's come to another topic that we've discussed a fair amount, and that is infrastructure. To what extent could infrastructure at this point, an investment in infrastructure, help us with some of that problem on future productivity? Or do we have to wait for that for later until we take care of the immediate crisis?
Well, we all have our wish list of silver linings to a crisis, and this one is mine, David. I would love it if finally the political stars would line up behind a major infrastructure initiative in this country. It's been well known for a decade that we are woefully underfunded on infrastructure, and that if you travel through the U.S., you begin to feel more and more like you're in a very poor country. But now we actually have, one, states and municipalities where a lot of this is needed need money, and two, we desperately actually need to put people to work. So maybe the political stars can line up across all three of those rationales, and we can finally get the support we need for a major infrastructure bill. And I would emphasize that this is not just a matter of money. This is actually more a matter of getting the right structures, the private-public partnerships in place so that we have projects that are ready to fund. There's actually a lot of private capital that is available and wants to fund infrastructure, particularly on the debt side, if we can get the right structures in place. So it's not just an allocation of money that we need, but we actually need a federal structure that helps to organize, share best practices, and force through many of the zoning and planning changes we need in order to get these big projects done.
And finally, David, you manage an awful lot of money on behalf of a lot of people who need that money over the long term. They want to make sure it's there and that it's increasing at the right rate over time. Give us some sense, on a scale of 1 to 10, 10 being the highest, what's the level of anxiety among investors right now?
Well, it's very interesting, David. I would say I can tell within the first 10 minutes of a meeting with a CIO whether they were the CIO during the GFC or not. I think in general, most of the major pension funds around the world and other large pools of capital are still managed by people who had a lot of experience coming through that. And I can say there is no panic in that. They are taking their time. They're being very deliberate about how they want to rebalance back to this. And they're taking advantage of the fact that they can get into asset classes and into securities at prices they couldn't before. And so on the institutional side, I actually think that there's a good deal of stability and a nice long-term view. I worry more on the retail side, where we've had a lot of flight out of pretty much all assets and into money market funds. And I worry about the lack of being invested in the market, and that many people will have actually missed the bounce and will miss the bounce the next time by their actions. But on the institutional side, I've been very, very impressed actually at the disciplined and long-term nature of most investment decisions that I see right around the world.